Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Market 5. I'm your co-host, Joel Elconin, along with Brianna Valesky. We have Adam Sarhan on the line. He is the founder and CEO of Sarhan Capital. How you doing today, Adam?
Excellent. How about you?
We're doing good here. Looking forward to the long weekend and the holiday. But before we get to that, how closely do you follow the markets overnight? S&P's collapsed around 8 o'clock last night. We found a little data, maybe something out of China. Could you give us your take on that? And are you out there trading at that time of night?
No, absolutely. We follow markets. We have two products. So the futures service that we offer is 24/7. Whenever futures markets are open, we're on and we're trading them. And then we have the equity product, which is during the day, and that's normal market hours. As far as the futures, we're not actively day trading in the evenings or nights. Just to be clear, we're an intermediate term time frame, so we have buy stops and sell stops. So we have rules to get us in and out anytime the market moves. So stepping back, let's just take a look at where we are year to date. The quarter just ended yesterday, and typically what we've seen over the last few years, Joel, is that we've seen a weakness in the overall market, both equity world, but Main Street as well. In the first half of the year, going back since the Great Recession ended in '09, and then whatever happens, magical powers, you call them the invisible hands, central banks, you fill in the blanks. All of a sudden, the second half of the year comes back with really a nice strong vengeance and really have a nice end to the year. And this year is exactly the same exact trend is unfolding in real time. So let's get down to the actual meat and bones. What's actually happening? The S&P 500 is flat for the year. It ended its ninth quarterly win streak, which is the longest in decades. The NASDAQ is up 9 quarters in a row also. Granted, wasn't a big quarter for the market, but there's still an up quarter nonetheless. Now, the NASDAQ, it's the longest consecutive 9-quarter win streak in history. The NASDAQ is also flirting with that 5,000 level, which was the same level back in March of 2000. So really, you've seen a big move. We're 6 years into this bull market. The bull market started, interestingly enough, a few weeks ago, but in March of '09, and we just celebrated the 6th anniversary in March of 15. So by any normal definition, this is an aging bull. The last few bull markets ended shortly after their 5th anniversary. 2002 low, 2007 was 5 years. In the 90s, you had a 5-year run. In the 80s, you had a 5-year bull also. So this is now an aging bull. But the reason why this bull continues to roar higher is because of an unprecedented action, coordinated action from global central banks, which we spoke about before, and that really plays to the whole central bank put that's alive and well. So whenever the market gets in trouble or Main Street, central banks step up and just flood the system with liquidity, and then it forces buyers into equities. And that's formed somewhat of a dislocation. So right now we're seeing the equity market, stocks in general, remain very, very strong, stubbornly strong. Now you see big swings like last night. You've seen heightened volatility, but I really want to urge your audience not to pay attention to the VIX, because the VIX does not do a good job measuring volatility in the market. It does a great job of measuring fear, but it does not measure upside volatility. So this week alone, on Monday we saw the Dow soar about 300 points, and then it fell 200 points on Tuesday, and now overnight it fell even harder, and then now it looks like a flat open here. So I'd be a little bit down open actually. So I'd be really careful. Once you see heightened volatility after a big move, we're 6 years into this bull. We haven't had a 10% correction since June of 2012. We're way overdue for a nice little pullback/correction here. But the fact that the market's not pulling back is very, very strong.
Okay, all right, that's a good breakdown of it. Okay, how about crude oil here? Have we found the bottom yet? I know you were pretty successful playing it on the short side. Are you still short? Are you looking for an entry point on the long side? Let's talk crude oil.
Yeah, no, absolutely. The final thought, sorry, but on equities before we move to crude, it just hit me before we move on, is that we are still in a bull market for stocks. So by definition, pullbacks should be bought until we get material technical damage. That's really, really important to note. But as far as crude oil is concerned, I'm no longer short. We covered our shorts about 2 weeks ago, and we first came on your show right around $89 with the short. But more or less, I feel that crude oil right now is struggling really hard to find this bottom, but it's trading for the past few months right near $50. Whenever it gets above 50, it falls. Whenever it gets below 50, it rallies. But it's forming a bullish double bottom pattern. So technically, it's doing its best to bottom. So you had a bullish double bottom is basically after a big move down, you see two like a W form in the chart where you have one bottom, it rallies, and then it undercuts that bottom, hits a little bit lower bottom, and then rallies again. So basically, it's doing its best to form that double bottom. It's still range bound. In other words, a technical buy signal is going to be triggered when it gets above the middle of the W, which in crude oil's case is somewhere in that $54 area. 55 would be the all clear for the bulls to start probing aggressively on the long side. Now, conversely, if the recent lows are taken out, this double bottom pattern is going to be negated, and that's the low is 42.41 to watch in crude. And if that low is taken out, we're probably going to test the mid-30s, if not lower.
A lot of the bearish thesis is built on the large positions. I don't know if you followed the commitment of traders at all from Steve Breezy, the large commercials that are still holding long contracts. And if they, finally flush out here, that's what could push us down to big capitulation move. Do you see that as a possible scenario or not?
Yeah, no, we definitely follow that. Any and all data is definitely important with respect to what traders are actually doing, not what they're saying, but what they're actually doing. So that's a good data point to watch. But it tends to be a lagging data point because it's not released in real time. So what we look at is the price action coupled with sentiment. And we're very big on sentiment in general. We believe that price is a function of perception, not necessarily fundamental or technicals, but that psychological analysis is a coin that I termed a long time ago. In addition to using fundamental analysis and technical analysis, we're very, very heavy on all markets with psychological analysis or crowd behavior. And right now, what really you saw was a game of chicken, for lack of a better way of explaining it, between OPEC and the rest of the world back in Q4 of last year. So what happened was OPEC said, you know what, we're not going to cut supply, and then all of a sudden, cut production, which reduces supply, all of a sudden crude prices imploded. And they fell over 50%. So right now, it's important to be mindful, just like equities are in a bull market, crude oil is in a bear market, period. So when you're operating in a bear market, the path of least resistance, by definition, is lower. So rallies typically are to be sold, and then you see a leg lower, it moves sideways for a few months, consolidates that move, and then moves lower again. That's exactly what's been happening with crude. So right now you're in one of those, you had a big leg down, now you're moving sideways for a few months, you're digesting that move, you're building a new base, if you will, and then if support's taken out, that 42.41 level, one would have to expect another leg lower to commence.
What do you think about solar stocks? One of our veteran traders in the chat, SF Bright TG, wants to know what you think of the solar stocks. I have TAN up here, which is the ETF. Is there any individual issues in the solar sector you're keeping an eye on?
I'll tell you, the solar stocks in general are one of those areas where I feel like fast forward it's the future. So fast forward 5, 10, 15 years down the road, I'd have to venture to say that if they're able to get the cost down and make it affordable for the masses, the stocks are going much higher. Now, outside of that, how do you actually make money trading them? They've gone virtually nowhere since '07. You've had a big move down. They got crushed in '08, and then they kind of bounced back, but not bounced back as strong as everybody else. But more or less, right now, these solar stocks have done a great job because of market forces to consolidate and improve their technology. But they have a lot more room to go just to get back to their '07 highs. And in 2007, right before the market topped, leadership in the market, the S&P meaning the market, meaning the equity market, topped, you had solar stocks really emerge as leaders. And leadership narrowed very, very heavily. So I remember back in October of '07, right before the market topped out, it was the summer of '07, and solar stocks were just on fire. And they were really, those guys and the fertilizers were the strongest stocks in the market, period. So right now, with oil prices coming down so much so far, that's not necessarily good for solar stocks, or even alternative energy stocks in general, wind stocks also. There's a big wind conference I'm speaking at in a few weeks, and these investors want to know what happens with crude oil. Why does that matter? Well, the higher crude oil is, the more attractive these alternative energy plays are. But the lower crude oil is, the weaker they are. So OPEC did its job crushing crude and keeping supply high because a large portion of them, the conspiracy theories, if you will, want to say they want to crush their competition. So what better way to crush the shale players and the Canadian oil sands and and even other competitors than to just bury the price of crude? They've been making so much money for so many years. They could afford a temporary month and 1 year decline in oil. The other guys that are newer players that are weaker hands can't. They'll get flushed out of the market, and then prices can go back up. They can cut supply, and then they'll be back in control, and they have no competition. And that's more or less the conspiracy theory towards why oil prices are as low as they are. And it's a coordinated effort from those OPEC members to keep supply high, and then in turn send oil prices lower.
Okay, one more macro here on gold, and then we'll go to some individual movers. Gold left for dead here a couple weeks ago. Looked like we were going to take out the lows of the move, come back, get back over 1,200 here. Is it just only a matter of time before we get under $1,000 in gold?
That's a great question. Gold has been one of our best trades back in 13 when it had that 200-point decline in 2 days. Thankfully, we were short at 1520, and the next thing you know, 2 days later, it's down 100, 200. Since then, since it was actually the end of Q2 in 2013, gold has more or less moved sideways. So keep in mind, let's step back and look at it the 30,000-foot view. Gold is in a bear market as well. The all-time high in gold, all-time high, was hit in September of 2011 at 1923 an ounce. Now, that was a huge bull market. That bull market ended. Since September of 11, so almost the last 3.5 years now, gold's been steadily moving lower. And by a bear market, I mean any market, it's a decline of 20% or more from a recent important high. So you had a big move down in 12 and 13, and then all of 14 more or less, and the first half of 14, let's put it that way, gold really moved sideways to consolidate 13's and 12 and 13's big decline. Then you broke down below support at the end of 14, which was at 1180 level, 1179. Then all of a sudden, in November of last year, I was on your show, we said the same thing. It's like, listen, that breakdown was negated, and it jumped right back up, not just it jumped, I think it was like 150 points or somewhere in that area, all the way up to January's high of 1307. And then in January, gold rolled over, and now for the last 2 months, it fell right back down below that 1,200 level. It's sitting at 1192 right now, and more or less, gold's having a hard time catching a bid. So it's still in a bear market, bigger picture, long term. Intermediate term, it's moving sideways, and short term, it's just choppy. If these lows are taken out, which were last year's lows of 1130 in that area, you definitely have to argue that gold's going to break 1,000 and go lower. Conversely, if it's in the next move wins is one of my trading rules. Right now, if gold breaks out above this little trading range here and gets going, you could easily go back up to new highs, but you have to see a catalyst. And right now, that's what's lacking out of this market. So on the downside, I'd watch 1130. On the upside, I'd watch that 1307 area. But more importantly, I'd watch 1400, which is a long ways to go from where we are right now. Otherwise, it's choppy.
Adam, I'd love to talk.
The other point too, sorry, Brianna. The other point too that I want to bring up to your audience is look at volatility. I mentioned this as a bad gauge for volatility. In oil, the last 2 weeks since the middle of March when oil bottomed, oil surged 20%. It was over 20%. I think it was like 23, 24% from March 17's low all the way up to the end of March's high. So, gold, same thing. It jumped 7 or 8%. These are major, and not just these two markets, other markets as well. Sugar was up, I think, 12% or some crazy number like that. These are major global commodities, and they're trading like penny stocks, and that typically is not a good sign. One of our in-house research things, we look at volatility across the board from a macro standpoint, and that typically leads to lower equity prices down the road. If the central banks weren't printing out of the, up the wazoo, I'd have to say the market's going lower. But as long as that central bank put is alive and well, even just last week we saw the equity market got in trouble a little bit. Yellen came out after Friday's close, gave a speech that she's going to be dovish, which means more printing, which means buy stocks. And that didn't really work. Futures were still down Sunday night. And then all of a sudden, Ben Bernanke, the first U.S. Federal Reserve chairman, decides to become a blogger.
Oh, yeah.
Posts his first blog post Monday morning at 6 a.m., and boom, stocks soar 300 points. That's not normal. And that's why we're seeing this bizarre activity in the market, because it's just bizarre, for lack of a better word. So I'd be cautiously optimistic here. We're still in a bull market for stocks, but there's a lot of dark clouds forming in the periphery.
That's a great point, Adam. We've got about 5 minutes left with you, so I want to talk about some of the stocks that are moving around in the pre-market session. Social media, always a big topic. Jefferies initiated coverage on Twitter, citing online video ads as a key catalyst. What are your long and short-term outlook for Twitter?
Yeah, I'm bullish on the social media section area of the market in general. I think SOCL is a good ETF for the space. I own Twitter, Facebook, and LinkedIn. Have for a while via Find Leading Stocks, on and off, and they've showed up in our setups week after week. But this is a very, very strong area. If you look back at the Nasdaq, now everyone's talking about 5,000, the March 2000 highs. Social media, the industry itself, did not exist. And that's what many newer people to the market fail to recognize. I mean, this is literally, it's an innovative space. It did not exist before. So going forward, it has changed the world, so to speak, and lots of business is getting done, and it's going to continue to grow, and dot, dot, dot. So basically, with Twitter, the stock came out, had a big IPO, everybody got involved and was excited, had a little bit of a run-up back at the end of 13, and then really all of 14 did nothing, if not go lower, which is good and healthy. Facebook had the same exact scenario. It went public in May of 12. It fell hard, didn't do anything. It actually fell 60% in the first 3 months. And then in July of 13, the next year, Facebook just surged and went through the roof. Twitter is now doing the same thing where it came public. It's been dead money since the IPO. Now it's trying to last 3 months to catch a bid here and go higher. If it's able to continue this rally, I would have to say the next important high to watch would be October's high of 55.99, right around $56, and then go back to the IPO highs of the in the mid 60s to the low 70s. But I think this thing's going higher. The entire space in general, I'm bullish on.
Yeah, that's a great point about how this space didn't exist at all just a few years ago. Biotech, another really hot topic right now. I know DYX Corp came out with some positive drug results this morning. I'm not sure if there was news on Organ Novo, but do you have thoughts on either of those ones?
Yeah, and biotech, just important step back also. I always look at things in 3 time frames. There's a short, intermediate, and long term, right? So let's just step back. And I always ask myself, am I early in the cycle or in the move, or am I late? There's no question unequivocally that biotech is somewhat late in the cycle as of right now, meaning it's been one of the strongest, if not the strongest area of the market since the March '09 low, especially over the last 3 to 4 years. This has been just a tremendous amount of growth for the individual stocks, the ETFs, dot, dot, dot. So right now, I'm hard-pressed to say you're early in the move, meaning I'd have to expect some kind of a nice pullback here, just like what happened last year in the IBB or any of these biotechs last year in late February, early March. You had a nice steep pullback, which was a significant pullback. And then all of a sudden, the buyers, it shook out the weaker hands, and the buyers stepped up, and boom, you were up from the highs, and you're up, I think, 30 or 40 more percent from now, from where you were just last year. So all these biotechs, I think they're an incredible business. They're helping people. They're changing the way people live their lives. They're helping people live longer. And you look at some of these companies like Kite Pharmaceuticals that are fighting cancer, and Blue, and Biogen with the it's remarkable what these biotechs are able to do and how they're able to help humanity as a whole. Hence the higher prices in their stocks, because they're able to monetize it. And as technology improves, every day technology improves, the closer we get towards major breakthroughs and cures, and that's why these stocks are really, really strong in the market right now. And of course, the demographics. The baby boomers are retiring in droves, and they're going to need a lot of these products that these biotechs produce.
That's another great point, Adam. Unfortunately we have to let you go because we got to grab our next guest. But Adam Sarhan, founder and CEO of Sarhan Capital, he joins us at the beginning of every month for a great look on macroeconomic, the overall market, specific sectors, pretty much anything you want to ask him about. He's got a well thought out answer. Adam, always it's a pleasure having you on the show. Thanks for joining us.
My pleasure. Thank you.